Hello and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching MF Corner. Joining in today, we have Anubhav Srivastava, partner and senior fund manager at Infinity Alternatives. And today we're going to talk about alternatives to equity investments. Why? Well, recently we have seen the mutual fund flows data come through, and we have seen that, equity mutual funds, the flows into that are sort of falling. Even within the flows that are there, a lot of that money is going into NFOs. However, SIPs are still holding on. So what is the reason? Where is this money going? Is it that the savvy investors know that there is another alternative which is available to equity right now? Why is it preferable? Or is this money just being churned within equity? Well, if there is a need to look for equity alternatives, what are they? All of these are questions that Anubhav will be answering. So Anubhav, thanks very much for joining in. First, I want to ask you the very basic. Is there a need to look for alternatives to equity investments right now, and why?
So thanks, Amara. Always a pleasure to be here. I think it's, you mentioned, do savvy investors know, is there something better? I think the answer is somewhere, tangential to our, understanding of equity markets. What's happening is that equity markets have gone through a very, very volatile phase. So you've seen these market recoveries and then market falls and all of that in a very, very short period of time. And what that is doing is to retail investors or even to sophisticated, HNI type investors, what it is doing is scaring them. Because when you have a wild, swing that's happening in the market of the variety that we've seen in the last maybe 6 months or so, then investors need to price in that risk. Unfortunately, while the markets have recovered, that risk is not getting rewarded adequately. So what we are seeing right now is people are beginning to look elsewhere. A couple of places that we've seen are obviously, the straightforward bond markets are looking interesting because the yields are high. The commodities markets have gone through a bit of a pandemic, oriented boom. So they're wondering if there's anything else left there. So there's all kinds of questions that are being asked as to, do we really need to be in equities and face this volatility, this such a huge amount of volatility, or are we looking at alternative, investment classes, asset classes, or are we even looking at a different way of dealing with equities? So all of these questions are front and center of all investors' minds right now. Not just investors, even advisors are wondering, because the multi-asset chaps that were out there were also suffering because everything became so heavily correlated. The bonds correlated with equities, correlated with commodities. A large part of it was driven by liquidity. The central banks were then looking at whether they were going to pull that liquidity. If they pull the liquidity, the risk, the economy is going into a recession. So it was a little bit of confusion all around as to what is the situation and where is it that things are going to stabilize. And in the meantime, are there things that people can do to negate the effects of this highly volatile scenario brought on by all kinds of factors like wars, oil price hikes, supply chain disruptions, and so on.
So, Anubhav, if there is the need to look for this alternative, what is that alternative?
Great. So, the first straightforward question, we've seen balanced advantage funds and all of these, big NFOs that came up. Somebody collected 700 plus crores. Somebody else collected even larger than that. So a huge amount of monies went into all of these NFOs. And the one big reason for the money going into these NFOs was that people were looking at debt. Now, traditionally, everybody has said, look, equity if equity begins to look risky, let's go to debt. That's going to be better. There is a higher yield. Plus, if the interest rates fall again, we can get some money out of it. Now, that is a very, very traditional thinking, because what we've seen in the last 7, 8, 10 years maybe, is that in inclement market conditions, equities and bonds correlate. However, at this point in time, bonds are looking quite interesting for investors to get into, both from a yield perspective, which is basically the kind of interest that a bond pays out, as well as potentially longer term, you could make some money if the interest rates fall.
Okay, so basically the bonds currently you're saying are offering way better yields, and therefore, and of course, a low risk investment as well, right? But what is it that people should be aware of if they're looking to invest in bonds?
Right, absolutely. So bonds tend to be a little bit more complicated than equities. The first thing is you can't, look at a price of a bond and buy it and sell it, for the simple reason that you need to know what is the kind of yield that the bond is offering. Because an equity is in perpetuity, all bonds have a finite life. Even if you look at the perpetual bonds that are out there in the market from either corporates or banks, these perpetual bonds will have a call, which basically means that the issuer of that bond, which is a bank or some corporate, can actually call in that bond, which means that they can write to you and say, okay, this is where this bond ends, and you need to basically the bond gets extinguished and the money gets returned. So in terms of the kind of the different kind of bonds that are out there, we do need to be a little bit careful about what we're investing into first. That is the nature of the bond. We need to be careful about what is the credit worthiness of the person issuing the bond, because basically you're lending money, and the instrument, which is the promissory note, which is called the bond, which you can then trade in the market, it depends on the credit worthiness of the investor. You need to know how long you're lending money for. So the shorter the duration of the period of the bond, the residual maturity or the duration, the lower the risk, the higher the duration, the higher the risk, and therefore you'd want a higher return there. So very broadly speaking, these three key parameters do need to be kept in mind when you're looking at bonds. The next bit is that, familiarity. If you have some obscure company, from which you've never heard of, that's issuing a bond, versus, let's say, the government of India that's issuing a bond, you do need to know that you go into things that you understand and you're actually comfortable with. Or you need to do something in between. So let's say at one end is XYZ investment company, right in the middle would be a bunch of these banks that are issuing bonds, and then at the other end of the spectrum you have the government of India. So potentially, if you could invest in any of these three sort of scenarios: high risk, medium risk, low risk.
Okay. So Anubhav, but for a retail investor, which is the most convenient way to invest in these bonds? Do you mean to say that, look at bond funds or look at bonds directly?
Perfect. Now, if you are a very, very small investor, I would advise you to get into, direct bonds. The simple reason, if you buy small lots, you will get hit by illiquidity premiums, the odd lot sizes and so on. So the best way for a very, very small investor, like somebody who has a few thousand rupees to invest, would be to get into a bond fund or a bond ETF, depending on how comfortable you are with things. For everybody else, the ideal way of buying a bond maybe a couple of years ago was you simply call up your bank relationship manager, and the person would then give you a menu of XYZ bonds are available, and you choose which one you want to buy. You will get a yield, and that was the end of that. Money gets debited, a bond get credited to your Demat account. Now, of course, there are many, many more options where you have people like Harmony. You've got a bunch of wealth management outfits and so on, who actually give you a menu of bonds that you can buy. So they basically, what they do is they aggregate liquidity. There are a bunch, which is basically calling up a bunch of people that want to sell the bonds, and another bunch of people that want to buy the bonds, and present that as a quasi market on their platform. Now, the way that works is that buyers and seller agree on a price. Monies get transferred and exchanged not directly, but through the settlement processes of outfits like NSCCL, which is basically a clearinghouse for clearing bonds. And so that's one good way of doing it. You don't really need to do very much there. If you have an existing Demat account, that's good enough. You just sign up and you can trade. The other way to do it is that you have primary issuances coming out. So you'll see these ads in newspapers where XYZ companies issuing something, or even the government is raising money directly into various kinds of bonds, whether it is infrastructure bonds or whether it is rural electrification bonds, or a bunch of these other government schemes that issue bonds. So you could just apply for them directly, but that's more opportunistic. When the opportunity presents itself, you would apply. But the better way of doing this is to go directly into the bond market. Yes, you do need to watch out for what is the yield and how long is your money going to be in for. And you should be prepared for a scenario where you do not have liquidity to sell that bond, but you will need to hold it to maturity.
Okay, Anubhav, one more question. When you're looking at buying bonds directly, the way a mutual fund scheme would buy bonds is that they'd probably ladder it up, etc. How do you build a portfolio of these bonds, if you're either taking it directly or even the indirect route?
That's an amazing point that you've raised, because it's not just important to buy a single bond and keep it. That is never going to work for you. Over a period of time, what you really want to do is to get a bunch of bonds. Now, what should those bunch of bonds be? First, manage risk, because there's a trade-off. Lower returns, lower risk, higher returns, higher risk. So you want to go across the spectrum and what we call ladder a portfolio. So you need to have a variety of risk. Maybe again, depending on entirely on what an individual's risk appetite is, you take some medium risk bonds or high risk bonds if you're okay with that, and take a bunch of government bonds and bank bonds and so on, right? So that's on the risk side. Second thing is, if you have an income requirement, you need to then ladder up a portfolio based on duration or residual maturity. So you can buy bonds that are maturing in 1 year, 2 year, 3 year, 4 year, 5 years, right? That kind of thing. So in 5 years, your entire money is back, and every year there is a bond maturing. So if you have an income requirement, you can do that and get the income out of that thing. Last but not the least, you do need to understand certain features of the bond. There is something called a zero coupon bond, which means that you'll get your money at the end of the period, which means everything that you make is basically capital gains, which is lower than your income. So, planning your bond portfolio based on your specific marginal tax rate and all is a very important thing to do, because at the end of the day, you don't want to get into a scenario. So let's say you get a bank bond, which is offering you 8%, and there is a fixed deposit that is offering you 6.5%, but you get hit by 33% or a 40% taxation on the 8%, which doesn't really help. So it's important to look at the bond portfolio at an aggregate level, which means you have to plan it out a little bit. High risk, medium risk, low risk. What are the kind of bonds you will hold? Also, you need to figure out for how long each of these bonds that you have. So on a different axis, you'd have 1 year, 2 year, 3 year, 4 year, 5 year, or even longer periods if you think that's something that you want to do. So both of these features will then get you into a bond portfolio that will look like a fund, but you're controlling it.
And I welcome back with us. We have Anubhav Srivastava, who's a partner and senior fund manager at Infinity Alternatives. We've spoken about some alternatives to equity investment, but one more question remains, which is whether gold is still a hedge, and how should you buy and sell it, which is how can you optimize rather your gold exposure. So Anubhav, first question is whether gold is still a hedge, and what place does it have in a person's portfolio as of now?
Thanks, Umera. The most interesting thing that has happened to gold markets over the last few years during the pandemic was that first all those correlations broke, and then we've started to see gold behave the way it is supposed to behave, which is that it is weakly correlated with equity markets and potentially bond markets as well. So we've seen, if you were to track the price of some of the popular gold ETFs, which is a real indicator of demand and supply, we've seen that equity markets have gone down. Sometimes gold goes up because there is a flight to safety. Other times when the equity markets boom, you have a scenario where gold tends to languish a little bit or go down marginally as well. So I think some of the problems that we saw with market dislocations over various asset classes in the years 2020 and 2021 now seems to be coming back. So we are looking at normal multi-asset allocation portfolios that are beginning to do well and do what they're supposed to do. So I think in the longer answer to this is that the gold is again potentially a hedge, so long as nobody else starts to sell massive amounts of gold. And then what we are likely to see is there is a flight to safety. So demand for gold is going to continue.
Okay, but there are any number of ways to invest in gold and even silver, and we are seeing a lot of schemes also being launched now for this, primarily to cater to this exposure. So what are the various ways and which is the one you recommend?
Great. So gold, the most common way of investing in gold for time immemorial has been physical gold, right? It started off with jewelry and then it went on to bars, but there was a huge problem with, who determines what the value of that bar is and whether it is really gold, because nobody really has any means of trying to figure out that it's gold without actually, melting it down. So therefore, one of the interesting innovations in investing in gold first on the physical side was these 30 card packed bars. They go up to about 100 grams and they come packed in credit card sized tamper-proof packing. But the interesting thing, and the reason why it's called a 30 card, is that behind that 30 card is the certificate that says that this gold is genuine. It does a couple of things. One is that due to physical movement of that bar, the value of that gold doesn't get affected. It's 30 card packed, so potentially you could go back to somebody and sell it and liquidate it and so on. It's a fairly liquid commodity. So that's the one thing. The only catch is that you will have some manufacturing charges, and storage is a huge issue. I mean, if you are going to start to store 20 and 30 and 50 lakhs worth of gold in your house, you better have a lot of security to do that. So that's one on the upside and the downside. The second way of investing in gold would be things like e-gold. Now, e-gold is basically nothing but large bars of gold that somebody buys and keeps in their vault, and you get an undivided share of, let's say, 1 gram, 2 grams, 10 grams, 100 grams, so whatever money that you've subscribed to. Now, this is a unique thing that has developed over the years, where people were trying to solve this problem of storing gold at home. It's a great way to do it because you own the physical. You may pay some storage charges and so on, but the gold is theoretically safe. However, there is no mechanism to actually monitor a lot of these things right now. While it is permitted, you'd want to be a little careful about who the issuer of that e-gold is. The next big way to invest in gold is obviously the sovereign gold bonds. Now, the interesting thing is there is no gold at the end of the sovereign gold bonds. It is simply taking the value, the price of gold when you buy, and price of gold when you basically the bond matures, plus added, there's an added interest to it for a few percent. So instead of actually paying people for storage and those kind of things, you do have some money coming in, but there is really no gold at the end of it all. Secondly, this is subject to government regulations, and that if somewhere in the future they change, you run the risk of being caught short on that. Last but not the least are the gold ETFs. Now, gold ETFs also have physical gold that are backing each and every unit that gets traded out there. They trade on the exchange. So at any point in time that you want to sell the gold, that you basically sell the units on the exchange. And then you have the ability to, even buy whenever you want during obviously stock market hours. Interesting thing is in large quantities, you can also redeem that gold. However, the requirement for that should be a pretty large sum of money. Due to the new recent changes in ETFs, you'd probably need to do about 25 crores if you're not a market maker to go redeem that gold. So if you're looking at physical, the first method tends to be one of the better ones. If you're looking at an allocation to your portfolio gold as an investment, then my view would be that an easily traded, liquid, regulated mechanism for investing in gold like an ETF is the best way to go forward.
Okay. So Anubhav, I mean, I'm assuming that we're talking about gold not just for investment in gold, but as a portfolio hedge, right? So therefore, what is the portfolio allocation that you recommend? And if the choice is to go for a gold ETF, how do you differentiate between the several on offer? I mean, is it all the same?
Right. So let me answer the first question first. If you're looking at a portfolio hedge, now obviously it depends on how risky the rest of your portfolio is. Let's talk about a 70-30 portfolio where 70% of the money is in equities, which could be domestic or international. Then you are looking at maybe 5 to 10% and not more than that in gold. What that does is it allows you to cash out of equities when the markets go high, or cash out of gold when the markets go low. So anything more than that is not really required because you will have long periods of poor performance, in terms of returns, etc. So you don't want to You want to create a hedge and not really a drag on the portfolio. The second question that comes up is which gold ETF? Now, there are lots of gold ETFs out there. Pretty much every single fund house, actually, not pretty, I guess about 60-70% of the fund houses have a gold ETF or a gold fund in some shape or form. I think the couple of things to note is the size. The larger the size of an ETF, more it's likely to give you finer pricing when they buy and sell the physical gold at the back end, right? So those would be important, better liquidity. That would mean that when you go buy and sell, there's more trading, right? A rider out here is that a large size does not necessarily mean there's going to be immense trading, as we've especially seen this on the equity side of things. But in gold, that would necessarily be the case. The third thing is that experience matters. The longer a gold fund has been in experience, the more you're likely to have a better fund manager. The rider, of course, is the longer it's been in existence, you might have costs that have been added to it.
Understood. Anubhav, thank you very, very much for your time today. And it was a very, very interesting chat. And I hope that everybody watching also benefited from it. So with that, we'll wind up on MF Corner. Do stay tuned. The team of Closing Bell joins you next.